Good afternoon, this is Sean Golden with Golden & Golden, here to discuss the basics of tax treaties. The United States has entered into over 50 different international tax treaties, income tax treaties specifically. There's various other types of tax treaties. There's estate tax treaties, there's totalization agreements for Social Security contributions, there are FATCA agreements, Foreign Account Tax Compliance Act, but this focus is just going to be on tax treaties. We can go on forever, but we're going to keep it to about 5 minutes to give you just a baseline understanding. So what happens is the United States enters into different tax treaties with different countries. The purpose of the tax treaty is to impact the way the tax rules will work between two different countries, right? The United States and a foreign country may have various different tax rules completely disparate from one another on how things are taxed. For example, sometimes pension may be taxable in the US, not taxable abroad, or certain types of passive income may not be taxable abroad, but it's taxable in the US. So what happens when a resident of that country resides in the US, and things of that nature. There's various different aspects to the tax treaty. It normally impacts things such as real estate, pension, dividends, permanent establishment, which impacts business income, things of that nature. And as you could probably imagine just from this quick introduction, that tax treaties can be very complicated. There's versions, and then there's revisions, and then there's protocols, and then there's new treaties and new protocols, etc., etc. Let's just go through some of the basics. The first thing to keep in mind when you're reading a tax treaty is the saving clause. Now, the purpose of the saving clause is to impact the application of treaty benefits. So, in a common example, which we'll deal with in a minute, there may be, if a person resides in a foreign country, and then in that foreign country, pension may only be taxable in that foreign country. So if that foreign country doesn't tax pension, then the U.S. person, for example, would get away scot-free without paying any tax. And so what the saving clause normally does, it says, hey, no matter what kind of benefits you may get in the treaty, scrap all of that, because we are reserving the right to tax the individual or business based on how we would otherwise tax it under our general tax rules. Now, so you have the treaty that gives you certain benefits. You've got the saving clause, which limits the application of benefits on certain types of income. Then you have exemptions or exceptions to the saving clause that says, hey, these carve-outs from the saving clause are not going to be subject to the saving clause, so that the treaty benefits will still stand despite any saving clause. Okay. Again, when it comes to saving clause, pension is a very common issue for individuals. So let's go through some important tips about tax treaties in general and how the rules apply. Pensions, for example. The reason I talk about pensions a lot is because it's a very common issue. In the US, you have a 401k. 401k contributions are tax-free. It grows tax-free. And when you start receiving distributions, oftentimes it's at a reduced tax rate because the taxpayer is now retired. And foreign countries have the same concept. You have a superannuation in Australia, you've got a CPF in Singapore, you've got EPF, MPF, etc., etc. So what happens is the way public pension is taxed is normally different than the way private pension is taxed. Private pension is normally taxed in the source of residence. Public pension and Social Security is normally taxed source. So that's source where the income is being generated or derived, versus residence, where the resident lives. And of course, oftentimes the saving clause will impact how that works. Other types of passive income, interest, dividends, royalties, things of that nature, it's normally, the way it works is like this. It's normally taxed in the country that the person resides, okay? But the country of source typically reserves the right to still tax that income, but up to a certain percentage, 5%, 10%, 15%, depending on the category of income and the type of treaty. But what will happen is, it's just to ensure that taxes are being paid somewhere, because oftentimes foreign tax credits will eliminate, if not reduce, the amount of tax, that there's no double taxation. Real estate's another common one. Most treaties use the word may, which says if a person lives in one country, is receiving real property income from the other country, then that other country may still tax the income. So it's basically going to get taxed both places, but again, the foreign tax credit should eliminate, if not limit, any double taxes that would be paid by the individual. permanent establishment is super complicated. More so because of the introduction of the Tax Cuts and Jobs Act in 2017. Most of these treaties have not been updated. But for the most part, the way it works is a resident of one country, let's say a business in country A, and there's a treaty between country A and B. And forgetting any triangular kind of, any funny play, right? Just country A, there's a corporation. If they have a permanent residence in country B, and that's a legal term that's defined in the treaty, then country B can tax the income that's being generated by the permanent establishment in country B. If there is no permanent establishment, then typically country B cannot tax the income. So of course the goal is to not have a permanent establishment in country B, or to have it in a triangular sort of fashion to avoid any tax, although more recently treaties are working to avoid that. If you're out of compliance, and of course reporting is required. Most treaties have something called exchange of information, and the idea is that the countries will exchange information in order to promote or facilitate the treaty, the goal, which is to promote tax compliance in both countries, fairness. If you're out of compliance, which is often the case if you haven't been reporting your income, you haven't been reporting the foreign assets, accounts, or investments, common, you didn't know a superannuation is reportable, or you're from an Asian country, which is commonly they don't tax things like passive income, where unfortunately even if you're a US person, you're generating income that is generally exempt in an Asian country, but you're a US person, then unless you're applying treaty benefits, or you're only taxed because of substantial presence and you qualify for closer connection, you're going to be taxed in the US. So there's various amnesty programs to help you get into compliance. If you're willful, or just can't certify under penalty of perjury that you're non-willful, and not because you were goaded because of some ridiculous fear-mongering online, you qualify for the Voluntary Disclosure Program, VDP, which is now used for domestic and offshore ever since they did away with OVDP, which was an offshoot of the program specifically, or primarily, for offshore matters. If you're non-willful, there's various other disclosure programs you qualify for. There's streamlined domestic, streamlined foreign, reasonable cause, and delinquency. We have lots of free information available on our main websites and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your specific matter. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.